Do you have concerns about the stability of your money? I don't blame you. Economic indicators and global events seem to point to some very heavy stuff happening over the coming year. In March 1933, in the throes of the Great Depression, Franklin D. Roosevelt declared a bank holiday, temporarily halting all bank operations across the United States. This bold action highlighted how fragile financial systems can be. Even though we've seen many crashes throughout history, we haven't done much to make them less likely to happen again. In fact, they are cyclical and relatively predictable. It's been 10 years since the financial crisis of 2008, which was triggered by the collapse of the subprime mortgage market and the subsequent failure of several major financial institutions. Lehman Brothers, one of the largest investment banks, filed for bankruptcy in September 2008, causing widespread panic and turmoil in financial markets. The crisis led to a credit crunch, stock market declines, and a sharp contraction in economic activity. The banking sector was severely impacted by the crisis, leading to a wave of bank failures. Between 2008 and 2014, numerous banks, particularly smaller community banks, failed due to exposure to risky mortgage-backed securities and other toxic assets. The number of bank failures peaked in 2009 and remained elevated in the subsequent years before gradually declining. This video aims to unravel the tightly wound threads of financial crises, guided by historical insights and illuminated by indicators in today's economic environment. Previously, there were two other notable recessions in recent history, 1981 to 1982 and 1990 to 1991. And then there's the most recent recession discussed above from 2008 and 2014. So we are 10 years due and banks are beginning to close and fail. Just the other day, Republic First Bank went under. In December 2023, Bank of America announced the closing of 19 branches. When banks intend to close any branches, they must notify the Office of the Comptroller of the Currency, OCC, at least 90 days before the closing date. This notification is made through an advance notice of branch closing. These notices are shared by the OCC in weekly newsletters, which can be found on its website. However, in cases of emergencies and insolvency, banks have closed without the proper notice, but it doesn't hurt to check the OCC if you have concerns about your bank. Banking, by its very nature, is predicated on trust and the delicate balance between deposits and loans. The genesis of banking instability often lies in the disruption of this balance, typically exacerbated by a cocktail of aggressive expansions, lax regulations, and economic myopia. What does this mean? So that you understand, banks don't put your money away in a big depository and just hold it. Your money is being used to invest to make the bank more money, which is not shared with you. And what makes this practice even more concerning is that banks often invest your money in very high-risk investments and borrow around 10 times on every dollar. For instance, an example would be when a bank uses your money to pledge 10% of a, say, $1 million loan. So you give them the down payment, they borrow a bunch more money from the Federal Reserve, who prints it out of the air. So it's all on paper, of course, but if your bank investments go bad, so does your money. Then they decided they could make even more by securitizing mortgages and selling pieces of your mortgage to thousands of investors after those pieces were bundled with pieces of other people's mortgages. This made it impossible for homeowners to locate all of the people who owned their mortgage for legal purposes. It was a nightmare, but guess who won? The banks. Courts foreclosed on thousands of homes by waiving proof of ownership of the mortgage. It was so unfair to homeowners in all probability had no idea that their mortgage had been sold off in pieces. As time progressed, so did the complexity of financial products and the scale of banks' operations, setting the stage for larger impacts of any potential missteps. These missteps, while varied across different eras, appear on a reoccurring, almost cyclical nature, And it's the people who lose the most. But wait, I know you are thinking, what about the FDIC? My money is covered by FDIC, right?
In the event of a bank failure, the FDIC acts as the receiver and liquidates the failed bank's assets to repay depositors and other creditors. The distribution of assets among depositors and creditors depends on various factors, including the priority of claims, the value of assets recovered, and the presence of any secured creditors or other claimants. The FDIC provides deposit insurance coverage for up to a certain limit per depositor per bank. As of 2022, the standard insurance limit is $250,000 per depositor per insured bank per ownership category. Deposits within this limit are fully insured by the FDIC. If a depositor's total deposits exceed this limit at a failed bank, they may not receive full reimbursement for the excess amount. A review of the FDIC data shows depositor reimbursement rates from 1% to 99%. The time it takes to receive payment from the FDIC for deposit losses due to a failed bank can vary depending on several factors, including the complexity of the bank failure, the amount of insured deposits, and the efficiency of the FDIC's resolution process. Here's a general overview of the timeline in spite of what the FDIC webpage says about reimbursement within a couple days. Use your heads, guys. This is the reality. Initial communication must first occur after a bank failure. The FDIC typically communicates with depositors through mail or electronic means to provide information about the status of their deposits, including whether they are fully insured or if any excess deposits are at risk. Next, claims must be processed. Depositors may need to file a claim with the FDIC to recover their insured deposits. The time it takes for the FDIC to process these claims can vary, but it typically involves verifying depositor information and determining the amount of insured deposits. Once the FDIC has processed the claims and determined the insured amount, it initiates the payment process. Payment may be issued via check or electronic transfer to the depositor's designated account. The timeline for receiving payment from the FDIC can range from several weeks to several months, depending on the efficiency of the FDIC's processes and the complexity of the case. In straightforward bank failures, with relatively few depositors and clear insurance coverage, payments may be processed more quickly. However, in larger or more complex bank failures, the resolution process may take longer, delaying payment to depositors for months.
From historical ledgers to modern news reports, the chronology of banking failures serves as a timeline for the evolving economic doctrines and policies. There were a couple of banking collapses back as far as the 1700s, but we're going to focus on 20th and 21st centuries, where the landscape becomes littered with more frequent and severe banking crises, including those during the Great Depression and the savings and loan crisis of the 1980s. Each of these crises added layers to the understanding of financial instability and spurred adaptations in banking regulations. In juxtaposition to these historical upheavals, the late 20th and early 21st centuries exposed globalized financial markets and digital banking operations to failures on a global scale, and increasing the speed and surprise at which these financial institution collapses can occur. The Great Depression serves as a quintessential case study, not just for the severity of its economic impact, but for highlighting the domino effect in the banking system. The initial stock market crash of 1929 triggered widespread panic, which, coupled with poor regulatory frameworks and risky bank behavior, led to an epidemic of bank failures. Nearly half of America's banks had failed by the time the crisis had bottomed out in 1933. This collapse was not merely a national saga, but had international reverberations, affecting financial institutions and economies globally. The aftermath led to profound shifts in economic policy, including the introduction of the Glass-Steagall Act, which imposed banking reforms that would define American banking for decades. This historical episode provides crucial insights into how policy responses can either mitigate or exacerbate the duration and severity of banking crises. Importantly, it also highlights the critical role of government intervention in stabilizing financial markets during times of extraordinary distress. The 2008 global financial crisis represents a modern archetype of a banking crash, fueled not only by poor lending practices and high-risk financial products, but also by a profound systemic entanglement that saw the crisis ripple across the globe. It began with the bursting of the U.S. housing bubble, which was heavily tied to high-risk mortgage-backed securities traded by major financial institutions. This event prompted widespread panic and a significant loss of confidence that froze credit markets and led to severe global economic downturns. The 2008 crisis is particularly instructive for understanding the role of innovation in financial products and the lag in regulatory adjustments. It underscored the necessity for more comprehensive stress testing of banks, better risk management practices, and more stringent regulatory oversight, leading to reforms like the Dodd-Frank Act in the United States.
Through the cyclical nature of banking crashes, certain lessons resonate with clarity, while others remain stubbornly unheeded. One clear lesson is the indispensable role of robust regulatory frameworks and vigilant oversight in maintaining financial stability. Conversely, a recurrently unlearned lesson is the underestimation of systemic risks posed by new financial innovations and global interconnectedness. This part of the essay delves into the wisdom distilled from centuries of banking crises, advocating for a balanced approach that nurtures innovation while fortifying the financial system against potential shocks. The juxtaposition of learned and unlearned lessons forms a dynamic narrative of progress and caution, a narrative that is crucial for policymakers, financial professionals, and the general public alike.
Predicting the timing and nature of the next banking crash might seem a quixotic endeavor, yet economic indicators and historical patterns offer some foresight. Factors such as rising debt levels, asset bubbles, geopolitical tensions, and technological disruptions could potentially catalyze the next financial downturn. This section employs economic theories and models to outline potential future scenarios, stressing the importance of proactive measures and continuous innovation in risk assessment tools to preempt and mitigate the impacts of possible future crises. By weaving together economic data with predictive analytics, this forecast does not just serve as a warning, but also as a guide towards greater financial prudence and preparedness. But we need the proper leaders in government to stop this downward spiral of the economy. Just because you may have never lived through a bank crash doesn't mean you won't. The fact is that we are already in that descent to a crash. Inflation is at the highest I've seen it since I was born. Fuel is nearly $4 a gallon from $1.70 just a few short years ago. Food is up 25 to 30%. The national debt is the highest in history, and we keep wasting money on supporting illegals while our own people can't afford to eat. The housing market is already showing signs of decline, but I promise you that we are nowhere near the bottom. Right now, the housing market is at the point where demand has ceased. Sales have stalled because mortgage rates are so high. People with adjustable rate mortgages will soon be unable to afford their new rates. So houses are sitting on the market many months. Some sellers are still holding on to hope of selling at last year's prices, thinking a $10,000 drop is going to sell their home. The drops have just begun. I have an active real estate broker's license, and I received a call the other day from a bank looking for brokers to list foreclosed properties for them. The banks see what's coming, and usually they make money either way. If a home loan goes into foreclosure, they only have about 10% of the loan amount invested. When the home forecloses, the loan guarantor pays the bank for the entire bad loan. Not a bad deal. Of course, these foreclosures look bad on paper, but the reality is that they are making money whether you go broke or not. The fear of the banks is people pulling their money out of them, as they have been doing in droves over the past few years. The buzz about the currency reset and going back to a gold-backed currency has caused many to liquidate and move their property into silver and gold. The banks aren't happy about that, and that's the move that is going to stop this entire farce of prosperity where countries owe the money changers big time. So much that they will do anything to stay afloat, even if it's in conflict with every moral or belief they had. It's called solvency, and for many the lack of it means that their life is over. That's the allure and control that money has. Moving to a gold-backed currency has significant benefits, including: a gold-backed currency offers several potential benefits. First, gold has been valued throughout history for its rarity, beauty, and usefulness, giving the currency intrinsic value. This can provide stability and confidence in the currency's worth. Second, since the supply of gold is relatively stable compared to fiat currencies, it can help maintain price stability over time. This stability can reduce inflationary pressures and preserve the purchasing power of the currency. Next, gold-backed currencies often instill greater confidence and trust among users compared to fiat currencies, which are backed solely by government decree and have no intrinsic value. This credibility can enhance the currency's acceptance in global trade and finance. One of the most important benefits of a gold-backed currency is that it limits government overreach. Tying currency to gold can limit the ability of governments to manipulate the money supply for political or economic purposes, thus reducing the risk of hyperinflation or currency devaluation. Next, gold-backed currencies can facilitate international trade by providing a stable medium of exchange and a unit of account that is widely accepted across borders. And lastly, gold has been used as a medium of exchange for thousands of years, and its historical stability can provide a guide for monetary policy.